This conference will now be recorded.
Thank you for joining me today. My name is Steve Tuttle, and I'm a portfolio manager and partner at Signet Financial. I'm going to discuss the volatile markets and share some strategies and some perspective on how to navigate the markets for investors. So since peaking in late September of 2018, the S&P 500, now that we're in May, 5 months into the new year, is now slightly positive, which has wiped out the nearly 20% loss we saw in the fourth quarter. We thought the sharp decline in late 2018 was a bit overdone, probably an overreaction by nervous investors. And I'm proud to say that we encouraged our clients to stay invested, and I congratulate you for riding out the temporary sell-off. So a few observations. Well, first of all, the big one will hit eventually. There will be a recession. There will be a bear market at some point, but this was not it. And some helpful observations that I think put things in perspective. If we look back at the past 7 months or so, there's a lot of similarities to how things typically work during a downturn. So while markets are selling off, everything gets killed. Cash and bonds are really the only safe haven. And if we look back at the fourth quarter, bonds again proved to be the steady hand during that market sell-off. And that's the primary reason for using bonds in your portfolio. Another key point is that no one really knows when the bottom will hit, nor when the losses will be made whole. If you recall, the media, market pundits, lots of people assumed the worst in late December and were predicting recession or worse. Finally, patience is generally rewarded. Sometimes these recoveries take much longer than what we've seen. Sometimes the depths of the losses will be even worse, but patience is generally rewarded. So I'll remind everyone, all investors, that market corrections are normal. They're a function of being invested in the equity markets. Even in good years, sizable intraday drawdowns are a normal feature of the market. And this slide highlights that. You can see going back to 2009, we had a lot of positive years in the marketplace. In fact, there were only 2 down calendar years over that period of time. But yet every year, even in the years that were very positive overall, there were drawdowns. And the point is, you need to stay invested. You need to have a strategy that can keep you in the markets even during times of stress. Now, if we look back at the fourth quarter to date, back to the peak in late September, you'll see the red line here. That's the S&P 500, and you can see it was a nasty, violent ride, particularly at the end of November to the end of December. Bonds, on the other hand, which is represented by the purple line, it provided a much smoother ride. And alternatively, if you had a combination of stocks and bonds, which is what many of our clients are invested in, if you had that combination, here on the green line is showing a balanced portfolio. You can see you were still exposed to some losses, some volatility, but it was not nearly as bad as stocks. And that balanced portfolio, just as stocks have recovered, that's done fairly well also. And over that period of time, the balanced portfolio has actually done better than the stock portfolio, although not quite as well as a portfolio of all treasuries. So a couple key points about how to increase chances of investing success. First of all, we encourage our clients to remain invested through times of volatility. It's been said that investing is simple, but not easy. So conceptually, rationally, it makes perfect sense to say, I want to be invested in stocks. Has historically been the top performing asset class, so that's how I'm going to invest. The problem comes that in order to receive those returns, you need to stay invested. You need to go through periods of negative returns, and that can bring out the worst of our human emotions. So you need a strategy that you can remain invested in through times of volatility, good times and bad. So if we look out over the next 10 years, generating return and yield over the next 10 years may be harder than the last 10 years. We're late in the business cycle. Valuations are getting a little stretched. I'd say they're still in a fair value range, but they're certainly not cheap. Yields are still low. So it's going to potentially be a tough environment for investors to generate high returns. The solution to us is to take a more professional approach, to be patient, to be disciplined, to grind out alpha or excess return when you can, and of course to manage risk, avoid those drawdowns. And so there's a few key things that I think are important for each of our clients, for each of our investors. You need to choose an investment strategy that works for you. This is a very personal decision. There's not one strategy that works for all people. It's very critical to have a plan that you can stick with. That plan should take into account the fact that there will be good markets, there will be bad markets, there will be surprises, there will be shocks. There also will be positive events that affect your portfolio. The key is that no one can predict the timing of stock market corrections with any certainty. So remove that from the plan and account for periods of uncertainty. Focus on what you control. We can't control returns in the short term. We can control the allocation, how much in stocks, how much in bonds you have. We can, to some extent, control how much you're saving and contributing to that portfolio, your expenses, and your risk level, the risk of the underlying portfolio. So those are areas that we want to focus on. Be opportunistic. When pullbacks happen, that can create long-term opportunity. You need to be ready to allocate capital when the markets at times can seem the most scary. Oftentimes, that's when there's tremendous value offered in the marketplace. And lastly, be patient. Market performance is unpredictable, in the short term especially. Even the most successful strategies are going to go through periods, tough periods of time. So for some investors, particularly those who are in retirement or near retirement, if you consider all those points I just went over, there may be a better way. There may be a way to participate in returns, to seek competitive returns with less risk than stocks. And if your goals and objectives can be achieved with a lower risk profile, with a lower risk strategy, that's a conversation we should have. That's something that we specialize. I personally specialize in providing lower risk strategies for clients to achieve their goals. And if I look out over the next 5-10 years, I see an environment, potentially volatility is back and it's here to stay, and expected returns may be a bit lower over the next 10 years than they were the last 10 years. To me, that means there's not a lot of opportunity costs for taking a slightly more conservative approach now. So if you were to choose that type of strategy, you have to be realistic on your expectations. The goal, again, is to achieve your returns, your goals, in as low a risk way as possible to still keep you on track. And in terms of expectations, that will mean that when the markets are going well, you're not going to outperform. You may lag a little bit. You'll still generate positive returns, but you're not going to participate dollar for dollar in the up markets. Where you're going to benefit more is in weak markets like we saw in the fourth quarter. In those scenarios, a more conservative approach, the goal would be to outperform during those periods of time when markets are weak. You still may lose some money, but it won't be nearly as scary or violent as an all-equity approach. So the key to a risk-managed framework is to manage downside risk, to try to enhance market returns when there's opportunity, to generate income if it's needed, sustainable income. Don't just reach for the highest yields possible. Be tax efficient. Don't pay excessive fees, and avoid emotional mistakes that can be brought out by violent and volatile equity markets. So just to recap what the benefits of a lower risk approach might be, you want to focus on capital preservation. I believe this is critical to increasing compound returns over time. When markets become volatile, here's the issue. When markets become volatile, investors have a tendency to deviate from their plans and make poor investment decisions. It happens again and again. As an advisor for nearly 30 years, I've seen this happen too many times. It's our human nature. I believe investors should accept as much risk as they need, but no more, to achieve their financial goals. And we can help you do that. So lowering risk while maintaining adequate returns, to me, is the goal. And that you will benefit in the following ways from that. Improve certainty of outcomes. We can, through a financial plan, we can show you the path and try to keep you on that path over time. Improved client experience, less stress. By smoothing out the bumps, it may be a little less scary to stay invested in volatile times. And then if you're taking distributions over the portfolio, it may be an easier way to extend the length of the portfolio, because we can set it up so that you can see each month, quarter, or year where the source of your distributions are going to come from. And many times it's individual bonds or CDs or treasuries with fixed maturity dates. So the key to all this is it's very common and it's very popular to focus on returns. It's all over the media. How do I maximize returns? The key, I think, is that lowering risk may also be an important goal. And perhaps it's a more important goal for clients who are near retirement or in retirement than when you're accumulating assets. That's the key to us. And it may be the key to your success. So if it's a conversation that you'd like to have, now's a great time. We're coming into 10 years of a bull market. You've probably benefited from a nice upward move in equities. Now's a great time to take a step back, take a look at your portfolio, complete a financial plan. If you have a financial plan, let's get it updated and let's see where you are. And if it's possible to take some risk off the table, now may be an excellent time to do that, and we'd love to help you do that. So I want to thank you for your time and continued trust. If you have any questions on this or any other information related to your portfolio at Signet, I'd encourage you to give me a call or send me an email. The email is up on the screen right now. Phone number 973-543-6660. Thank you for your time. And I'll end with a few disclosures. Thank you.